I get started.
Oh,
Oh, it is exactly what.
cool. All right. Thanks for coming virtually, guys, to my presentation. We are going to cover intro to tax deductions. Can everybody hear me okay? Just a thumbs up. All right. So this is just going to be a very basic and beginner class. We're going to go over what a deduction is. We're going to go over a little bit of math, nothing too complicated, and we'll walk through it quite a bit. So, and then we're going to go over some common types of deductions and some resources for how to file your taxes at the end of the year. So just a little about me. My clicker wants to work. Sorry, guys. Oh, there we go. Okay. So I'm an accounting student. I graduate next year in the spring, and I own a small business. I am co-founder of Pentacles and a Crow. I am not a tax professional. I am not qualified to give you professional tax advice. So for really detailed questions, I can try and do my best to help you, but it's a lot of tax accountants do consultations, and it would be in your best interest to ask very detailed questions to someone who can give you a very detailed answer. Everything in this presentation is going to apply to the tax year 2023 as stated by the IRS. These are going to be federal regulations. And tax laws are also subject to change. They are usually adjusted, mostly just the numbers are adjusted every year. Sometimes policies change. And state laws vary by state. Usually they're very similar. It's good to look up what your state laws are. We're not going to go over state laws in this presentation, just federal. Okay. What is a business deduction? So a deduction is an expense. So an expense is something you paid for, something you bought. An expense that you can use to reduce the amount of income you pay taxes on. When you reduce the amount of income you pay taxes on, you can lower the amount of taxes that you pay. So the government basically says, you have spent this money on your business. This money is not yours anymore. You do not have it. You do not have to pay taxes on it. So taxes paid, this is a little equation for you. So your sales, anything that you sell, any income that you make, minus your deductions, so minus the expenses that you can deduct, times your tax percent. We'll go over this a little bit more in detail, is your taxes paid. So more deductions is less taxes paid. Less taxes paid is more cash savings. That's good for you. This is money that you can use for yourself, use for your business, use to grow your business. Everybody loves more cash savings. So what a business deduction is not. A deduction is not free money on your tax return. This is a really common misconception. People will think a deduction is, like if you spend $200 on something, when you file your taxes, you get that $200 back. That's not the case. So a deduction does not reduce the amount of taxes paid by the total amount of the deduction. It reduces it by a smaller percent of the amount that you paid. Taxes paid equals sales tax minus deduction, or sales times tax percent minus deduction. No, this is not the right equation. So just ignore this. This is just an example of something that's wrong. Wrong. So just to reiterate, a common misconception is that when you take a business deduction, you get the amount back on your tax refund that you took. This is used to justify purchases, right? Because people think if I spend $200 on a tablet, then I get that $200 back on my tax refund. That's not true. You're still paying that money. You just get a small percentage of it back. So if you did get the full percent back, that's called a credit. It's not very common. You don't have to worry about credits probably. So they're not very common in business. There's certain credits like the child tax credit that you can take on your personal taxes if you have a child. But for business, credits are not good. Okay, before we get into the math of it, does anybody have any questions? Okay. So here's the math. So let's say you have $1,000 in sales. You sell $1,000 worth of stuff during the year. Your tax rate is 15%. So that's the percentage of your income that you pay taxes on, or that you pay for taxes rather. So 1,000 times 15%. So your sales times your tax rate. It's $150 of taxes that you pay. Does that make sense? So with deductions, you have $1,000 that you made in the year, and you paid $200 on stuff that you can deduct for your business. So your tax rate is still 15%, but because you can subtract the $200 from your income, from your sales, you have $800 that you actually only are taxed on. So that means you only pay $120 in taxes. So $120 is less than $150. You just saved $30, and the only thing that you did was on your tax return, you said, I spent money on my business. That's the only thing that you did, was you listed those $200 of expenses on your tax return. And that saved you $30. Now, this might seem like a low number, but you probably, I'm not saying that you didn't make more than 1,000, but you probably made more than $1,000 in sales this year. And you probably spent more than $200. So that can really add up. So here's an example using the same numbers. So I own a business, and one of the things that we make is stickers. So if I made $1,000 this year in sticker sales, and I spent $200 on sticker paper, vendor fees to attend events, and on making my stickers. So that's $200 in deductible expenses. If I could not deduct the $200, I would pay $150 in tax, right? Because that's 15% times the $1,000, because I cannot deduct the expenses. But I can deduct the expenses. So I only pay taxes on $800 of the sales that I've made. So that's 1,000 minus 200, right? And I only pay $120 in taxes instead of $150. Does anybody have any questions? Yeah.
If we wanted to know how much we will actually save on, say, the $200, would we just do 15% of $200?
So, it's actually, yes. So it would be the tax rate that you pay. So 15% is just an example. So it would be the tax percent times the expense that you deduct. So if we go back, you are correct. It would be 15% times 200. That gives you the amount that you save.
Okay.
Any other questions? All right. Does anybody need a break, or can we continue? Okay, cool. So there's some things called personal deductions. There's a thing called the standard deduction. So this is a preset amount an individual has the option to deduct on their income taxes. So for personal deductions, this is things that are not related to business expenses. This is something that everybody can take regardless of whether they have a business or not. So you have the option to either take the standard deduction or itemize your deductions. Itemizing deductions means that you list all of the allowed personal deductions that the government says that you can take instead of taking the standard deduction. So you get to pick one of these. So some examples of itemized deductions are medical expenses, interest on certain loans, and charitable donations. So keep in mind, you only get to pick one of these. However, You can still take the standard deduction and take business expense deductions because they are separate. So you can itemize your deductions or take the standard deduction, but you also get the choice to take business deductions if you're self-employed. So you can take the standard and business expenses or itemized and business expenses. For the majority of people, the standard deduction is more than their itemized deductions. It might not be for you. If you have a lot of medical expenses, then it might be better to take the itemized deductions. If you think that it'll be worth it, then it's better to take all of your receipts from the year and try and add it up and see if it's more than the standard deduction. And the standard deduction is pretty high. I believe it's about $6,000 per individual. Does anybody have any questions on personal deductions? And feel free to type your questions in the chat and we'll get to them when I have a good pause also, if you think of questions as we're discussing. Okay, business deductions. So here's some examples of things that you can deduct on your business expenses, and we'll go into all of these in more detail. So direct materials, anything that goes into making the product. Indirect materials is anything that goes into selling the product. Labor, so that's your labor and your employees' labor. Equipment, that's any object that's used to make the product or sell the product, but it's not consumed in making the product or selling the product. That means once you use it, you still have it. Rent and utilities. Interest on qualifying business loans and credit. 1/2 of self-employment tax. This one's going to be a little complicated. We'll get into it later. Legal and professional services. And more. All right, so direct materials. This is anything that goes into the final product. Anything that becomes a component of or gets incorporated into the product. So for my stickers, for example, that would be sticker paper, laminate, ink. That's what goes into the final product. If you're making jewelry, that would be the beads, the wire or string, the leather, if you make crystal jewelry, the crystal, the clasp, anything that goes into the final product. Do we have any questions on this one so far? Indirect materials. So this is anything that does not go into the final product, but is still used up. So anything that's used to sell, so shopping bags, packaging, anything that's kind of just like something that you use for your business. So like pens, markers, staples, all of that is deductible. Any questions on this one? Labor. So wages and benefits paid to employees are deductible. So that's your salaries and wages, your healthcare. Those are deductible when they're paid to employees.
I just have a question about indirect materials. For example, a Canva subscription.
That would actually, I think, be considered a legal and professional service. So we'll get to that later. So as a small business owner, you probably will not receive a wage for your work. This just means that you don't receive a formal pay, like hourly or salary. If you do receive a wage, this is unlikely. It is deductible from business profits, but you need to report it on your personal tax return as income like you would if you were employed by someone else. So this is probably not going to happen. If you're a sole proprietor or a partner, you're probably going to be taking wages out of the business, like taking pay out of the business as you make the profits. But if you file as an LLC or if you decide to incorporate someday, then you'll probably take a wage. That would be deductible from your business. But you would need to report it on your taxes. Just because you don't receive a wage does not mean you should not be paid fairly for your work. Try to factor how much work you put into each product. This doesn't just include time spent making the product. You need to incorporate time spent selling and marketing the product, administrative, any other time you spend on your business. Try to put it into the price of the product so that you receive a fair pay. Because a lot of people will say, I spent 2 hours making this product. If I pay myself $20 an hour, I should sell it for $40. And then you sit at a market for 5 hours and you sell one, so you made like $10 an hour less. So try to factor in selling and marketing. This is not a tax tip. This is just a business tip, if that makes sense. Do we have any questions about labor? Okay, I'm gonna get some water real quick.
I do have a question. What makes something a quote-unquote wage?
Can I just see this? Okay. So a wage is what you pay to an employee. So when you work for someone, when you have a regular job, you receive either a wage, which is an hourly pay, or a salary, which is a monthly or yearly pay. Sometimes you're paid on commission, which is a little more complicated. That means you're paid based on what you sell or make. So as a small business owner, you're not an employee and you don't receive a set wage per hour or salary per year. What you make out of your business is the profits, which is what you're being taxed on, essentially. Does that make sense?
They have a follow-up to that. What makes something a wage? For example, if you are a freelancer and you are paid for contracts for hosting classes.
So that is not a wage. That would be considered being self-employed, and it would you would not file that on your personal tax return. You would file a different form in addition to your personal tax return. I think you still file a Schedule C as a contractor. I can look that up real quick, actually. We have time. All right. So as a freelance artist, you would be considered self-employed and you would file a Schedule C. This is in addition to your personal tax return, where you would report any other income that you might have. It's a little bit different than being a contractor, which is when someone basically like pays you to do a set job it's similar to being a freelance artist. But I think as a freelance artist, you would be classified as self-employed and doing gig work essentially, and not as like an independent contractor who would file a 1099. So anything that you make from your freelance work, you would file on your business taxes, which would be your Schedule C as a sole proprietor. Does that make sense?
Jensen, thank you. Then we have a second question from another person. How or why does becoming an LLC change if you take a wage or not? So does becoming an LLC making you take a wage?
So for an LLC, you don't have to take a wage. An LLC is a really special entity where you can either take profits or you can take a wage and then also have profits. An LLC is really common for businesses with multiple owners. So like it's different from a partnership. You can also have it as one with one owner. But if you have multiple owners, it might make sense for your business to have certain owners take a wage if they do a lot more work for the business than other owners. Does that make sense? So you don't have to take a wage as an LLC. It's just an option for you. Okay. Any other questions?
Differentiate freelancer from gig work, or it's not basically the same thing.
It's basically the same thing, I think. Returning to Google. Let me see if I can get a really good. Thank you guys for bearing with me while I Google things. So freelancers work on their own terms, creating their schedules and finding clients. Contractors have fixed term contracts that they work for someone else for. So this is from Upwork.com. So essentially, if you have someone and you have a contract with them and they would say, you need to spend 8 hours a day working on this for 3 months or something. Contractors, when you're a contractor, you can't necessarily like, they're not allowed to dictate your working conditions. When you're a freelancer, it's basically like, maybe you'll set like a deadline, but you get to work on your own terms entirely. A contractor is also, there's a lot more like say that your contract can have. Whereas a freelancer, it's basically like you're just paid to do it. I think gig would probably describe both. Does that make sense?
It might be more specific.
Okay.
So if I have an LLC for my freelance work, but I also sell art under my own name separately from the LLC, would I need to file 2 Schedule Cs, one for the LLC and one for me being self-employed selling my art and then I would separate from the LLC?
I think this is actually something that I can about. From the IRS, if you own more than one business, you must complete a separate Schedule C for each business.
So it would be self-employed selling your art and then
Yeah, exactly.
is a thank you.
Yeah, no problem. Any other questions? Cool. Okay, so another thing that you can deduct is equipment. This one's going to be a little complicated. I think we'll take 5 minutes before this. If you need to use the bathroom, now would be a good time, or get a snack or some water. And we'll come back at 1:28. You think I should wait for everybody, or? Okay, cool.
Mhm.
Let's get back to it. Um,
So there was one question in the chat. Is there a minimum where if you stay under that amount, you don't have to pay taxes on it? For example, if you sell art out of a studio.
so if you end up spending just as much as you make or more, you do not have to pay taxes on it. Excuse me. That's actually kind of easy to do. There's a lot of stuff that you spend on your business, and if you like take all of these deductions that you can take, it's not super difficult to end up with a net zero. If you take, let's just say for ease that the standard deduction that we talked about earlier is 6,000. If you made less than 6,000 from your business, and well, total income, if you made less than 6,000, then you would not have to pay taxes on it, except for the employer share of self-employment tax, which we'll go over in a second. So it is possible to pay zero taxes, but you need to have enough deductions to basically eat up all of your taxes, or to eat up all of your income. And unfortunately for a lot of people, you're going to have that be pretty much the case. Just because it's hard being a small business. And I mean, it's good because you don't pay taxes, but also, like I said, deductions are not free money. It just means you pay less taxes, which less taxes is good, right? It's money that you don't need to pay out of pocket. But just because you're taking all those deductions, if you have a net zero from your business, that's not necessarily like, you shouldn't aim to have a net zero. It means you don't pay taxes, but it also means that you spend a lot of money on your business. Unfortunately, that's just often the case.
I am just starting out with my business, and I have spent a lot on getting things started, far beyond what I have made this year. Can I carry over the loss this year to next year?
So yes. I believe also if you have income from your employment, like if you're employed outside of your business, that you can deduct it against your employment. But there is something that we're going to get into for equipment, which is probably a lot of what you spent your money on this year.
They followed up and said, I am not employed currently.
Okay.
Only for where they're offering a loss for their person.
Yeah, you can take a loss on you can carry that forward to next year's, but you might not have to, because we're going to go over equipment, and probably a lot of the stuff that you spent this year is going to be on equipment. Which means that you can take zero this year, essentially, and take more deductions next year. So we'll get into that, and that might be really helpful for your scenario. Any other questions? Okay. So equipment is anything that goes into like running the business that doesn't get used up. So an example would be computer equipment. So tablet, laptop, so like an iPad, a drawing tablet. For me, my manufacturing equipment, that would be my printer, my cutting machine, my button press. Any of that would be manufacturing equipment. Selling equipment. So this is anything that you use to sell or display your products. So for me, that's my tent, my tables, my display stands, my tablecloths, and my credit card reader. So this is just the physical reader. This is not the fees that you pay, which we'll get into later. So all of this and lots more are considered equipment. There's pretty much anything that you buy that you like keep that doesn't get used up is going to be considered equipment that you can deduct. Does anybody have any questions so far before we get into how to deduct your equipment? Is it something we covered already?
Is kind of, is there a scenario where commission-based work can be filed under your small business?
So I believe that you would have to file it separately because it would be considered not a core business product or service. I think you would have to file it as a separate self-employed business. But that would be I will, let me write that down and I will have Schrader email it to everyone so that everyone has the answer to that question who was on the mailing list.
The commission work be filed under.
Yeah. You can file it under, if you have a business for your commissions, you file it under that, obviously, but I'm assuming you're talking about a separate business where you like make and sell a different business. Is that the case? Is that what I'm? Because if your business is making and selling commissions, then yeah, you would file it under that business. But if your business is making and selling jewelry and you do art commissions on the side, I think if you did jewelry commissions, like if someone made a custom request for jewelry, that you can file under your business. But if it's not considered a core business process, then you would have to file it under a separate business. If your business is making and selling art and you do a piece and then you sell that piece as your part of your business as well, then I think you can make a case, but I will get back to you on that. So the rule of thumb is equipment should be used entirely for business to deduct the full amount of the equipment. If it's used partially for business, you can deduct the amount that it's used for business. So if you use it about 40% for business, you can deduct 40% of the purchase price. They're not gonna like come and look at your YouTube history on your iPad and see that you watched a YouTube video while you were drawing and say, you can't deduct your iPad. That's illegal. They're not gonna do that. They just want you to be like honest, you know? So if you listen to music while you're drawing on your iPad, they're not. But if you use it for other things, like if you use it for cooking, you look up recipes pretty often. If you use it for like other leisure activities, like you read on it, then you probably want to figure out just like an estimate of how much you use it for your business. That's just an example. Also, you could do that for a lot of other things, like a printer that you also use for school, your laptop that you use for everything. If you use your tables for your display, you also use them for other stuff. You might want to do like 50% or however much you use it for your business. So you would basically just take the full purchase amount and you would say, I use it half for business. So you would multiply it by 50% and you would get half of the amount, and that's how much you would get. Do you have any questions so far?
We have another question about operating the loss.
Okay.
So this person asks, sometimes we have to spend so much more than we earn. In this case, what can we do? And I think maybe if you're comfortable sharing like a copy of these slides, I can email it out to everyone too.
Oh yeah, for sure. I mean, the slides are going on.
I listed deductions.
Yeah.
So again, asking, what do we do if we're spending more money than we're earning consistently?
On dance, you could deduct uniforms, you could deduct any equipment that you have in your studio if you have a studio. You can deduct the rent and utilities from your studio. You can deduct any fees that you pay to perform. If someone charges you, I don't know if you get charged to perform or if people pay you to perform. if you do performances. You can deduct, if you have like a theater performance and you have an usher, you can deduct the wages that you pay the usher. You can deduct all of the wages that you pay the concession people. You can deduct the cost of the snacks that you sell if you sell concessions. What kind of art can I get?
Well, I actually know this person is part of a, folklore. Like, dance group, like a community-based group, and they do some benefits, they travel, so travel costs, hotel costs. And they do pay for, dresses, performance dresses, and, like PA systems, things like that, and I believe they do use the local space, but I don't know if it's mostly benefit to the night, if that would be.
Okay. Yeah, even if it's like on a case by case basis, if you pay to rent it, then you can still deduct, deduct that. As far as like the PA system, that would be equipment. It would probably be considered computer equipment. These are just my categories also. There's not really much difference between these. These were just the categories that I came up with to kind of give you a better idea of what you can deduct as equipment. I'm trying to think. Excuse me. So if you feed your dancers, like if you buy people pizza, you can deduct 50% of that. It's a little risky. The IRS really likes to audit people who deduct a lot of meals. But you can deduct it, you're allowed to. And if you get audited and you do everything right, you're gonna be fine. But do you have any other ideas of things that might be? Because I don't really know this person's situation, so, and I'm not much familiar with dance.
I mean, I think that you listen would be,
yeah, if you have any specific questions of like something you think might be deductible, I think I can answer that. If you want to know, like, is my costume deductible? The answer would be yes. So if you want to drop those in the chat, I think those would be the appropriate things to answer. Okay, so for equipment, the way you deduct it is through this thing called depreciation. This is going to be a really hard concept. If you don't get it, it's okay, but we need to go over it anyways. Just try, if you understand the basic concepts, and we can go over this for as long as we need to, right? Until everybody understands. Excuse me. So, and this is going to be really helpful for the person who said they took a big loss this year, I think. And if it's not, so generally equipment is deducted gradually over the span of many years. This is because when you purchase it, you like still have that equipment with you, and it's still good for a very long time. So the IRS has categories that tell you how many years your type of equipment is deducted over. We'll show a table in the next slide, I believe. But they have like computer equipment, office equipment. They have all kinds of different categories with examples from those categories. You just go to the IRS website and it'll tell you what the categories are. Excuse me. And you just look up what kind of equipment that you're looking for, and it'll tell you how many years you deducted it. So they'll give you a percent for every year that you can deduct it over. And we'll have the table in the next slide, or one of the tables, I mean. So you take the percentage that they give you, and you multiply it by the full purchase price, and you get the amount that you can deduct every year. So this is a maker's table. This is pulled directly from the IRS website. So it's got different classifications of equipment. And again, if you go to the IRS website, it'll tell you what your equipment is classed under. And you basically just take the percentage for each year and you multiply it by the full purchase price. And this adds up to 100 this year. And you'll notice for a 5-year piece of equipment, it's actually deducted over 6 years. That's because the first year and the last year are 50% of what you would deduct that year. You'll also notice that it kind of starts really high and gets lower as it gets older. This is good for you generally, because it means you can deduct more earlier on. And when people say time is money, that's true. So when you save more money earlier on, that's really good for you. It tells you, so this tells you how much of the purchase price you deduct every year for a piece of equipment. Generally, you would start deducting a piece of equipment in the first year that you buy it. Sometimes you could deduct it in the first year that you put it into service, which is the first year that you start using it for your business. We'll go over an example on the next slide. Excuse me, the next slide, and then we'll take some questions about it. So, for example, a computer is classed as having a 5-year recovery period. So the computer will say costs $1,000. In the first year of purchase, you would go to the 5-year column and go to year 1, and you would get 20%. So you would multiply 20% times 1,000, and you would get $200 that you can deduct in year 1. So again, this is the amount that you can deduct, not the amount that you can save. So if you had a 15% tax, you would save $30. So that's where it is. For the year 2, you would go to the 5-year column and you would go to year 2 and you get the 32%. So you would multiply 1,000, the full purchase price of 1,000 times 32% and get the deductible depreciation of $320. So when you get to the end of year 6 and you file year 6, then you will have deducted the full purchase price. Okay. Do we have any questions on the depreciation or the maker's table? Okay. So this is kind of going to spread out the amount of loss that you took this year, hopefully, to the person who said that they took a major loss this year. Because it spreads out the amount that you deduct over a longer period. Which means you save money in future years and you pay 0 taxes this year. Hopefully. So there is this thing called bonus depreciation. This is not a permanent thing. This is just temporary. So last year, you could deduct 100% of qualifying equipment. This year, it's 80% that you purchased in 2023. You can deduct it on your 2023 tax return, which is what you file next year by April or whatever your deadline is. So 60% in 2024 is what you can deduct if you purchase it in 2024. This is all for new equipment. So if you purchase something in 2024, when you do your taxes for 2024, you can take a full 60%, 40%, 20%, because they're phasing this out. But this is just something that you can do for the next couple of years. It can be really helpful because you can deduct, for example, if you bought that $1,000 computer this year, you can deduct 80%, so you can deduct $800. Instead of, if you notice, we deducted $200 in year 1, $800 is obviously more than $200, and that saved you more money this year. Maybe not, obviously. So you don't have to do this. You do have to opt out of it. It's basically just like a little box that says, I choose not to take bonus depreciation this year, and you check it. So to the person who took a major loss this year, it might not be good if you do this year, but I don't know about your situation. But generally, it's generally better. But sometimes if you did take a major loss, that might be an example of a time where it might not be the best option for you. And again, this is not going to be permanent. This is being phased out currently. So do we have any questions about bonus depreciation or depreciation in general? Okay.
No. Can you explain why it wouldn't be the best?
Okay. So let's say
if you had a loss, can you explain why it wouldn't be the best?
So let's say you made $200 of income this year. So For this one, you would take $200 deduction on your computer this year. That would put you at 0 income. So you would pay 0 taxes, right? Because 200 income minus $200 deduction, that's 0, and you get taxed $0 on that. For this one, if you took an $800 deduction, that would put you at negative $600. So that would carry forward to next year. But it's a little bit more complicated to do that. And there's other rules, like you can only carry forward a certain amount. You can only carry forward you can only take deductions for previous losses to a certain amount of your income for the next year. There's a lot of regulations about carrying forward loss. So if you took the $0 income instead of the $600 loss, it might just be easier for you, and there might be less hoops that you have to jump through. But again, I don't know your personal situation. I don't know what you spent your money on this year. So you might benefit from taking the accelerated deduction, the bonus depreciation. Again, I'm going to reiterate this at the end, but a lot of accountants do consultations. I know there's someone I know who does $50 for an hour. If that's something that you can afford, you can ask a lot of questions about your personal situation, and they can help you come up with a plan for how to file your taxes and how to get you the biggest deduction. We'll also go over some free options later on for getting a good deduction.
For a second question about bonus depreciation. I'm trying to understand, they are just decreasing the amount that you can take in the first year, but right now it is a higher percent.
Right now it is a higher percent, yeah. So right now you can take 80% in the first year and the rest in the next year. And then after this year, you can take 60% in the first year and the rest in, I think it goes back to the makers table. So it would be 32% and then the remainder for the computer. So that would be 60% in the first year, and then I believe 32% and then 8%. And then they are just phasing it out, so it's slowly decreasing. And in the 2026 for the 20%, if you had, for example, a 3-year piece of equipment, then this one is actually higher. So it would maybe make sense for you to opt out in that situation for most people. Because it's only going to be 20% in 2026. Okay. Cool. Any other questions? Okay. So this is not really a tax concept. This is more of something that you should just be aware of for your business. So all of the things we just went over, so that's going to be direct materials, indirect materials, labor, and depreciation. These are all going to be components of inventory. This means that you don't get to deduct them until you sell the stuff. So for equipment, we already went over depreciation, so that's how you kind of deduct it over time. For direct materials, the way you would deduct it is you would say, I spend about 12 cents when I make a sticker, for example. If I sell and I buy $100 worth of sticker equipment, sorry, not equipment, sticker materials, and I only sell one sticker, and a sticker costs me 12 cents. I only deduct 12 cents on my tax return. I don't deduct the full 100. I only deduct 12 cents. This is because I still have that sticker material. I still have it. It hasn't left me, and the value of it hasn't left me. So these expenses become deductible as you sell the items, not as you spend the money or as you make the items. So this would also be like labor on manufacturing. This would be like incorporated in the cost of materials, or like the cost to make the product rather. This is called accrual basis. This is if you need more information on this, this is what you would Google is accrual basis tax accounting. So you might have the option to opt out of this system. Some businesses do, some certain types of businesses rather, but it's required for most businesses. If I can hit the right button. It's required for most businesses when they file their taxes, and it also offers more accuracy when you're determining your costs. Because if you think about it, like when I have that $100 worth of sticker materials, and I made $5 on one sticker and lost 12 cents out of it. I still have that $100 worth of sticker materials, or that $99.88. So I still have it, and I can still make money off it. And so I feel like I still have the value of it. I still retain the value of it. And I don't get to deduct it until its value leaves me. So it's important to keep track of how much materials, labor, and depreciation goes into each product, both for tax purposes and to better understand your business. So as far as depreciation, what you're going to do is you're going to use the depreciation table. But if you want to think about it this way, if I make 1,000 stickers on my printer and my printer then dies, and my printer costs about $300, there's 30 cents of printer in each sticker that I made. Because that's how much it made. It made 1,000 stickers. It cost $300. So there's 30 cents worth of sticker, or sorry, 30 cents worth of printer in every sticker that I made on that printer. So that's another way to think about depreciation. To know the true cost of what you're selling, you need to factor in how long it takes you and your employees to make, package, and sell the product, not just the materials. This is something that we already talked about. It's really important so that you price you price your products correctly. And so that you know like the true cost of what you're spending to put into your product. You also need to factor in wear on your equipment. This is what depreciation is. Again, there's 30 cents worth of printer in every sticker that I made on that printer that only made 1,000 stickers. This helps you set an accurate price. This helps you keep track of accurate costs. Again, this is less of a tax concept and more of just something that you should keep in mind for your business. The only thing that is a tax concept is that you do need to I think I need to break it a second. You do need to deduct direct materials and indirect materials as you sell the items. So that is something that you do need to deduct. You can't deduct the $100 of sticker paper that I bought if I only sold one sticker. Any questions on that? Okay.
If you are deducting taxes for, say, a computer over the course of 5 years, but it dies in year 3, can you still do those deductions for the final 2 years?
So I believe in that case you would deduct the rest of the computer in that past year that it lives. I will look that up. I can't find an easy answer on that, but I will write that down and I will get back to you on it. But you're still definitely 100% able to deduct the entire amount of equipment. It's just I'm not sure if it's immediately or over the rest of the lifespan of the equipment that the government decided.
Maybe we're just gonna lose that other nothing.
Okay, questions? Okay. So rent and utilities, before I get that, I'm gonna get some water actually. What time is it? 2 o'clock? Do we want to take another 5-minute break, TJ? Or take a break? Okay. I'll just. Okay, and then we'll keep going. I think we're all just. So rent and utilities. If you run a business out of your home and have a dedicated space that is exclusively used for work. So you take your rent, utilities, and if you use the internet for your business, you take your internet and any other like monthly expenses. And you take the square footage of your home and you take your rent and the square footage of your home and you multiply it by the square footage of your workspace. So if I have 1,000 square foot apartment and I pay 1,200 in rent, I wish. So that would be $1.20 for each square foot that you have. So if I have a 6 by 10 foot workspace, then I would multiply $1.20 by 6 by 10, so that's $1.20 by 60. And I would deduct $72 of rent every month on my taxes. So what is that? That's over $700, maybe like $800 a year. So that adds up. I obviously, not for tax reasons. I mean, obviously for tax reasons because you can deduct that space, but for not tax reasons, I would recommend having a personal space in your house that you use exclusively for your business. It helps you work. It helps you stay organized. If you run your business out of a commercial space, you can deduct the full amount of your rent, utilities, internet, any of your monthly expenses. Insurance, this is another one, you can deduct renter's insurance or homeowner's insurance. You can deduct mortgage too. I didn't put that, but you can deduct your mortgage instead of your rent if that's what you have.
I hear, this isn't a question, but I hear a lot of people talking about how they use like their kitchen table to make work and trying to deduct the square footage of their kitchen in their rent, and that is not actually.
You can't do that.
Yeah. A dedicated space. Yeah. So like if you're making art in your living room, that does not count.
It does not count.
It has to be a dedicated space.
Yes.
Like an extra room in the apartment, a basement.
Yeah.
Garage, things like where you're dedicated.
If you do have like a dining room and you don't eat there and you only use it, because that's what I do, is my fiance and I, our like 6 by 10 foot dining room is both of our workspaces. We don't really use that for anything else. But I will say, if they're not going to come and find a coffee rig on your desk and be like, you had a coffee.
Yeah, but just some people, just to be aware.
Yes.
That is what
yeah, you can't take a common space that's used for other things and deduct it because you do your work there also. It needs to be dedicated and it needs to be exclusive. Thank you for that. I almost laser pointed you in the eye. So this is something that confused me when I was starting out. So for pop-up markets, vendor fees are not rent, they are sales if you're selling, or these are just some guidelines. Sales if you're selling there, events if you're performing, and marketing if you're like marketing your business there. I have a friend who is part of a real estate business. This is really common for real estate businesses. She'll rent out a space and pop up in certain markets to advertise the business. So that would be a marketing expense. For me, it would be a selling expense because I sell out of the space. Do we have any questions on rent and utilities? Okay. Interest on qualifying business loans and credit. In order to qualify, this loan must come from an institution, such as a bank. It doesn't have to be a bank, but it has to be like a qualified institution. Your friends and family.
What about phones? Think you're at the cost of your phone or considering that as a utility?
So for that, that would be, I believe, a legal and professional service because it's not related to the square footage of your home. Well, it would be if it was your home phone. Maybe. But if it's a cell phone, that would be a legal and professional service. And as far as that, I believe that you would deduct it for the amount that you use it for business. It's similar to the way that you deduct equipment, 40% if you use it, 40% for business.
Then we have another question. Working spaces factor into this. I have a membership that I pay at a co-working space. I pay monthly, and that's where I go to do all of my freelancing.
I will look that up real quick and see if I can get a quick answer for you. I believe that would also be a legal and professional service. So according to coworkingresources.org, it counts as a home office. So you absolutely can deduct your membership. I will do some more research and make sure that it's deducted. And I'll get back to you. You absolutely can deduct your co-working space membership. It did make a point to say you cannot deduct commute or parking. That makes sense. Yeah. Yeah. Okay. Do we have any other questions?
Okay.
Interest on qualifying business loans and credit. So again, it needs to be part from an institution. Your friends and family are not qualified lenders, most likely. They will still love you. Probably if you don't pay them back. Your bank will not still love you under any circumstances. It must be specified as a loan for your business. So if you take a personal loan and you use it for business purposes, you can't deduct the interest on that. You must use the money from the loan and you must use it for its intended business purposes. I'm not sure why you would take out a loan and then not use the money, but you need to use the money on your business. Because if you don't use the money, then you're just paying money on money that you didn't use, right? And you must use it for your business. You can't use it, you can't take a business loan and use it for your personal, just like you can't take a personal loan and use it for your business. Only the interest is deductible. So if you were given $1,000 as a loan and you need to pay $1,000 and $100 back, you can only deduct the $100 extra that you pay. You can't deduct the whole amount of the 1,000. Does that make sense? Any questions? Okay. 1/2 of self-employment tax. So when you're an employee, a certain amount of your taxes goes towards Social Security and Medicare. This is known as FICA. Your employer pays the same amount on top of what comes out of your paycheck. So you pay about 7.5%, and your employer pays about 7.5%. So 7.5% comes out of your paycheck. They pay 7.5% out of pocket. It's about 7.5. I believe the total amount is like 7.65. When you're self-employed, you pay both of these halves. It comes out to about 15.3%, I believe. You pay both the employee and the employer portion. This is known as self-employment tax. So you don't have to pay both self-employment tax and FICA tax, because self-employment tax is FICA. So you're not paying this and this, you're paying self-employment tax, which is the 15%. The employer portion of FICA, or 1/2 of self-employment tax, is deductible. So your employer, when they pay the FICA tax for your paycheck, they can deduct that expense. So you can deduct that expense as well. Yeah. Yes. Yeah.
So it's the active year then.
Yeah.
Got it.
Yeah. So you would file it on the taxes that you are going to file next January through April.
Okay.
Do we have any other questions on this? Okay. And this is also in addition to your income tax. So this is separate from income tax, which is the one that goes up when you make more money. Legal and professional services. So there's lots of things that count as this. You got your accountant, your lawyer, credit card processor. So this is your Venmo, your Square, PayPal, invoices, any of those fees that they charge to process a credit card. You can deduct those. Or if if PayPal makes you like pay money because someone, how PayPal makes you pay money sometimes. I don't get it. And there's lots more that you can classify as like custodial services, be an example. Do we have any questions about?
Yeah, so when that person was asking about cell phone bill.
Yes, so this would be I believe a cell phone would be a professional service, not a utility. Yeah. Yeah. I will double check that though.
Question about the credit card processing. So for example, Venmo, Square, all of those places, it's like whatever percent of transaction plus the 10 cents, whatever that is. So that makes sense. You total those up through the year and deduct those. But what about transfer fees? So I always do the free one that takes 1 to 3 days. I don't want to pay a fee. But if you were to pay the whatever 1% fee for an instant transfer, would that count as deductible fees? It seems like an optional thing. So it seems like a great. We also have a question, website hosting costs, website fees, online software like Canva, Trello, those will all be professional services.
Yes, those are definitely professional services. I a good answer on instant transfer.
Okay, I have the feeling that was not. What?
So a lot of the stuff was said yes, but it was really vague.
Yeah.
So I'm not 100% sure. Yeah, those are 100% deductible. Do we have any other questions about this? So here's some miscellaneous ones. We went over this before, but 50% of meals for business purposes. Again, the IRS really likes to like say, you deducted so many meals this year. Obviously, those weren't for business purposes, but this would be like anything that you eat while you're at a market. Or anything that if you have a client and you go for coffee with the client, then that would be deductible 50% though, not the whole thing. But again, this one is a little bit riskier, so just be careful with that. Sales tax paid on business purchases. So this becomes the cost of the equipment, the cost of the direct materials, the cost of the indirect materials. There are certain circumstances in which you can file to not have to pay sales tax on direct materials that you purchase. So if you're interested in that, look into that. It's can't remember what it's called. Let me find what it's called so that you guys can Google it. But it basically just means like any materials that you purchase that are passed on to the customer, you don't have to pay sales tax when you purchase it. It's a sales and purchase exemption. So if you just look up sales tax exemption, and you should get more information on how to file for that. If you use a lot of materials for your business that you then make into a product that you sell to a customer, that might be a good thing for you to look into so that you don't have to pay those sales taxes. They'll usually give you a number and you give the seller your number and they'll just say, okay, no sales tax for you. Gas and car wear and tear for business purposes. There's two ways you can do this. You can either take the number of miles that you drove for business and divide it by the number of miles that you drove total and get the percentage. And then you multiply that by all of your car expenses for the year. So that would be repairs, gas, oil changes, that would be your registration, inspection fees, insurance you can deduct. You can also, it's probably easier, you can take the number of miles that you drove for business and write that down. And the IRS says you can deduct a certain amount. It changes pretty much every year. This year it's about 50 cents per mile. And just multiply that by 50 cents. And then it gives you a number that you can look up, that you can deduct. But again, that changes pretty much every year.
2023 rate is 65.5 cents per mile for business purposes.
I know there's two separate.
They have 22 cents per mile for medical and moving purposes.
Okay.
And 14 cents per mile for charitable purposes.
Okay.
So for business, it's 65.5 cents per mile.
Okay, so for business, it's 65.5 cents per mile, just to make sure that you guys heard that. So for people who travel for markets, that would be really helpful. Up to 20% of qualified business income. We're not going to go into this because this is really expensive. Sorry, not expensive, complicated. As far as what qualifies as business income. But your tax software that you use will probably help you with this. You can also Google it. And they'll probably just say, here's your qualified business income, and here's how much you can deduct. Travel for business purposes. So this would be, I know a lot of people that travel for conventions. This would be your flight, your train, your bus. This would be your hotel. This would be your Uber, your taxi. This is different from the gas, car wear and tear. Because this is like the full amount that you deduct, not the percentage that you drive. So if you drive for an event, like if you drive 100 miles, then you would take the 65.5 cents and you would multiply it by 100. But if you took a flight, then you would deduct the whole cost of the flight.
If you opted to do the mileage reimbursement for the 65.5 cents per mile, would you not be able to deduct the cost of the inspection permits and stuff like that?
Yeah, so it's one or the other. So the 65.5 cents per mile is an estimate that the government has for what the average amount that a person spends on their car per year would be. It's similar to the personal deductions where you can take either the standard deduction or the itemized deduction where you could list out every single thing, or you could take one given number.
So theoretically, you could figure out which one would be the deduction.
Theoretically, you could, if you have the time for it. And you need to keep your receipts also. So you would need to keep track of every single thing that you spent money on for your car.
We have another question. I am in a service-oriented business in healthcare.
Okay.
And I conduct the travel involved in attending training conferences for business purposes. Example, the hotel costs, airfare costs, and other travels to get to a training conference.
So are you self-employed or are you working for a healthcare company?
Self-employed.
Self-employed. Okay, then you would be able, if you're self-employed as a healthcare professional, then you can deduct those costs. So yeah, professional conferences, you would be able to deduct like the cost to attend those conferences as well. I believe that would be like continuing education or something like that. Yeah, so you can deduct those. Yeah, no problem. Advertising. So if you buy a $10 Instagram ad, you can deduct that. If you buy a billboard for some reason, you can deduct that. Business establishment costs. So it costs, I think, $20 to file your doing business as.
Yeah, I think mine is like, I did it in person and I was only like $12. Oh, that's really much.
Yeah, but you can deduct that. If you file as an LLC, it's way more. If you incorporate for some reason.
And the DBA is just a one time.
Yeah, the DBA, yeah. So anything that you do to create your business, you can deduct that. That's just some random ones. There's also more that you can find on the IRS website. They have a whole big list of them. I tried to condense it as much as I could, but there's lots that I didn't go over. Do we have any questions about any of these? Okay. So we're almost done, guys. What time is it? 6:20. That's not bad. Okay. Some guidelines. Keep your receipts for everything. In the case that you do get audited, you want proof. Keep your emails, keep your paper receipts. If someone pays you something, write it down. Keep track of expenses. Go through your bank statements and write down what you spend every month. This is going to help you with your taxes at the end of the year. There's some software that you can use to keep track of your expenses. QuickBooks is really popular. It's by the people who do TurboTax into it. It helps you guide you through the process of keeping track of your expenses and revenues. So that's anything that you sold this year. I use Wave Accounting, which is a free program that you can use. It's a little more hands-on, but it is free. So, yeah.
Receipts versus bank statements, which I assume this person is asking if you did really no, because the receipt is an itemized receipt that you can prove you actually bought items.
Yeah, exactly. The receipt is an itemized receipt. I'm just going to say that to make sure people can hear it. The receipt is an itemized receipt that proves that you bought things that go towards your business. So you could be spending money at Michael's, and it could be like candles, exactly. So you want to make sure you have proof that you bought something and it went towards your business. Your bank statement is going to be, receipts. Receipts it's proof that you bought something and it went towards your business. Bank statements are really helpful to keep track of like what you spent for you, because it can be really hard to keep track of every single receipt. I mean, you obviously are keeping them so that you can deduct everything, but also you don't want to have to go through your receipts at the end of the month and like tally up everything that you spent. It's going to be much easier to go through your bank statement. A lot of these programs will also, you can connect them up to your bank, and it will prompt you whenever you have an expense to say, was this a business expense and what was it for? And you can categorize them like that. So that's also something you can do, is you can hook it up directly to your bank and it'll do that for you. Stay organized. If you buy a lot of things in purpose, designate a place to stash your paper receipts, or you can take pictures of them and keep them on your phone or put them in a file on your computer. Keep them in a drawer. You should still keep the paper receipts, but just like keep them in a drawer. If it helps you to take pictures, then taking pictures is a good option. If you're really organized, you can categorize your emails and like archive them. If you have the ability to open a separate bank account, I would recommend that you do. It helps you keep track of your business expenses versus your personal expenses. It also helps the IRS know that you're not like spending stuff from your business money.
They also be careful, because even so, if you file like a DBA, which is doing business as, like mine is Schrader Art, that's my business name. But if I get paid in a check because I don't have a separate business account, it cannot be made out to Schrader Art. That doesn't mean I can accept checks just because I have a DBA. It has to be made out to my name. So if you want to be able to accept checks with your business name, you have to have that name linked to your bank account in some way. You just have to help your bank to set it up.
Yeah, that's a great point. So when you file for a doing business as with the Secretary of State, basically, if you want to be able to accept checks or payments as your business name, then to make sure that you talk to your bank and open a separate bank account and link that name to your bank account so they know that they can accept payments and checks to that name.
And we have another question. Are you supposed to, when you're keeping receipts and statements and everything, are you supposed to keep them for 5 years?
Yes, because the IRS can audit you up to 5 years for normal audits. I think it's up to 20 years for like fraud. I don't think any of you are gonna commit fraud. But usually the IRS is pretty, they care more about getting their money than they do penalizing you. So if you file your taxes wrong, they might come to you and say, you filed your taxes wrong, fix it. Unless they can prove that you were acting with intent to commit fraud, they are not going to do anything to you. They might slap you with a small fine. And then just say, pay your taxes.
Yeah, so the IRS website says, generally speaking, they usually only go back about 3 years, because they try to hit you if they find an error as soon as possible. They really hardly ever go back more than 6 years. But then the maximum that they can go back, unless there is some kind of fraud situation, is 10 years to actually get money.
Okay. Did you guys hear that okay?
Yeah, if you're nervous.
So
yeah, 5 years is like the general rule. So.
Yeah. So usually they won't go back more than 3 years. Sometimes they'll go back up to 6 years, and then the like maximum that they'll usually do is up to 10 years back. So it's just good to keep your receipts. Also, if you're especially nervous, I would recommend taking pictures and filing them away, because receipt paper can like degrade really easily. But yeah, definitely keep your receipts and keep them for at least 3 years, if not 5 years. That's a good question. Thank you. Any other questions? Okay. So help filing your tax return. If you have questions, many accountants do consultations. It may even save you money and stress, which we all know that we're, short on stress these days. It might help you to have an accountant prepare your taxes. So TurboTax for the self-employed costs $170 for your federal and state combined. Investopedia, I like Investopedia. It's a great resource if you want like really easy to understand information as far as finances. It says that the average for an accountant to file your self-employed taxes is about 412. So that is approximately like 250 extra. Plus 250, about 240 extra. Sorry, I'm tired. If you keep proper records, an accountant can help you save a lot more than you spend. So I've been using examples that are in the like $1,000 increments, just to keep it simple. Let's say I make $500 at a market and I do a market every weekend and there's 50 weeks in a year, let's say to simplify. That is, what is that, $25,000?
What was it, 50 times 50?
500 times 50.
25,000.
Yeah, so that's $25,000. You're probably spending like a lot of money on your business that you can deduct that you might not know about until you keep track of it. So the self-employment tax is 15%, right? Let's say I'm in the lowest tax bracket, which is 10%. So that's already 25%. State taxes are 5%. So that's 30% of your income that you're paying in taxes. Or state taxes for NC rather. So 30% of 25,000, that's a lot of money. That's $7,500 that you would have to pay without deductions. If you can deduct a lot of money, you can save a lot of that. And like I said, it's really common to pay zero taxes on your business just because of the amount of deductions that you take. Because you're definitely spending more than you realize. And again, you can deduct things like rent and utilities for the amount of space in your home that you use for your home office. You may also qualify for IRS free file. So this is free assistance on your federal tax return. I'll have Schrader drop the link to this in the email that we sent. But there's certain things that you need to qualify. You need to make under, I think it was $70,000 a year. And you have the option to have either free software or you can, there's certain instances where you can talk to an accountant to help you file your taxes. This is a great resource. I would highly recommend you check it out. Because you might qualify even if you don't think it. Thanks for coming, guys. Does anybody have any final questions?
Yes. So do you know if the free IRS assistance service will handle slightly more involved taxes, such as those depreciation scenarios? How do you get connected to an accountant for that?
So the link will have the instructions on how to apply for the free file, and I did check, and they do self-employment taxes. So they'll help you with a sole proprietorship, which is when it's owned by one person, or a partnership. They'll help you with that. It's a great resource. All you have to do is give them your information and they'll connect you with something or someone. Any other questions?
One more came in.
Yep.
For mileage tracking, do you recommend using an app or some kind of formal system, or is there a good method for tracking your mileage?
As far as as long as you write it down, like if you look at your odometer after your market and before your market and just take the difference, or your travel, and then just say how much did it increase after I traveled for my business purposes, and then just keep track of it. You can put it in an Excel spreadsheet, or I'm sure there is an app for it.
Yeah, there probably is an app. I have a Google Sheets spreadsheet,
Mhm.
and I put the date of travel, the address of where I came from and where I went, and if there's multiple addresses in the trip. And then I use Google Maps to give me an exact mileage, and I just keep it at the end of the year, it's sort of all over the whole thing.
Yeah, that's
So
awesome. Yeah,
but it's like, that's one of those things that you have to do as it's happening.
yes,
Cause it's really hard to go back and look at months and months of, when was I traveling, where was I, especially if you're not, I mean, if you're not the kind of person to write down where you're going every day, it's really hard to like backtrack and come up with that info. So even if this year you didn't do that, now you know for next year to like right at the start of the year, stay on top of it, like at the end of every month to just consolidate and make sure you got what you need. And then filing your taxes is not this like horrible thing when it's time to happen if you keep on it.
yeah. Yeah, exactly. Like a Google Sheet is a great way to do it. Again, just to reiterate, date, location. If there's multiple locations, write down all the locations, the address rather. And then the amount of miles, which you can pull from your odometer or from Google.
Yeah, they said, is that enough for like quote unquote proof that would be needed for the IRS?
There's no other proof that they can really take. So as long as you write it down, either in like Google Sheets, I would recommend either Sheets or Excel because it'll help you do the math on it and you won't have to type in all the numbers again into a calculator. Or if you have an app, they'll help you do the math for it. But there's nothing the IRS, unless you report that you drove like 1,000,000 miles this year and you took a huge deduction, like there's nothing that they can really use to determine how many miles you drove other than like what you wrote down.
All right, we don't have any more questions in the chat, but we do have a lot of people saying thank you.
Thank you. I'm glad you guys got something out of it. We're gonna stick around for a bit. If you have any more questions, or you're free to leave. We'll probably leave the Zoom up until everybody leaves the Zoom. So if you want to wait until everybody leaves to ask any questions, feel free. Although your question might still be in the recording, but the recording is not going to include the chat. So
yeah, I can go ahead.
Yeah, you can stop it. Thank you guys. Thanks for coming.